Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're diving into Karl Domm's fantastic book, A Portfolio for All Markets. It's all about his incredible 26-year mission to find a smarter, more reliable way to invest. And we're going to break down the core ideas for you.
I love this quote because it just gets right to the heart of it. This isn't some story about a magic formula or getting rich quick. Nope. This is about a 24-year journey of trial, error, and hard-earned wisdom. So let's dig in.
So where does a journey like this even start? Well, for Domm, it began with one simple, powerful goal: generating passive income. You know, the dream. Making money that works for you so you don't always have to work for it. But as we're about to see, the path to get there was anything but a straight line.
And when I say it wasn't a straight line, I mean it. Just look at this timeline. It all kicked off with a single share of Reebok stock, back when he was a teenager. Then in '89, he jumps into real estate. A few years later, in '93, he gets deep into trading options. But the really wild part? Look at this. Between 2011 and 2017, he built and tested 198 trading models. And guess how many he threw out? 154 of them. That's some serious grit before he finally landed on a system in 2018.
These early ventures, like this first real estate deal, were basically his real-world classroom. This is where he learned about all the messy stuff, like tenants who never seem to pay on time. But he also learned something really critical: how absolutely vital it is to have an experienced partner to help you navigate all those bumps in the road.
So, all this research, all this real-world experience, it all led him to a fundamental problem. A dilemma, really, that trips up so many investors, whether they're just starting out or they've been doing this for years.
And here it is, the big aha moment. After all that time, he concluded that trying to predict which way the market is going to go is basically a coin flip. The odds are just about 50-50. And if you build your entire strategy on that, well, you might as well be at the roulette table betting on red or black.
And this number just drives the point home. He cites this one study that found over a full year, only 11% of 54 professional portfolio managers were actually profitable. Just 11%. I mean, that really shows you how tough the prediction game is, even for the pros.
This isn't just theory either. Take a look at this table. It shows a portfolio of professionally managed mutual funds. Over 5 years, a $40,000 investment grew to about $58,000. Sounds okay, right? But if you had just put that same money into a simple S&P 500 index fund, you'd have over $71,000. That's a difference of more than 13 grand.
Okay, so if trying to pick a direction is a flawed game, then what's the alternative? This is where Domm's philosophy takes a really sharp turn away from what most of us are taught.
His big breakthrough was to stop trying to be a market psychic and instead focus on something called selling option premium. The easiest way to think about it is like this. You become the insurance company for stocks. You collect a small, consistent payment. That's the premium. And in exchange, you're insuring against a big, unlikely market move. You're not betting on which way it'll go. You're profiting from time just passing by and playing the statistics.
And that's the whole key right there. You don't have to guess if the market is going up or down. This massive shift in mindset, from trying to predict things to just playing the probabilities, that is the core of his entire system.
So that all sounds great, but how do you actually put it into practice? Well, it all comes down to a few core principles, the wisdom he earned over those 26 years. And this isn't just about what to trade, it's about how to trade it successfully. He boils it all down to these 3 essentials. First, you have to rethink diversification. We all think having lots of different stocks keeps us safe, but in a real market crash, almost everything falls together. He calls this crash correlation. Second, always invest with a plan. That means you define your rules, how much to invest, when to take profits, when to cut losses before you ever place a trade. And third, master your execution. You got to be aware of hidden costs like slippage, that little difference between the price you want and the price you actually get, because those little costs can really eat away at your profits. Ultimately, Domm presents the whole world of options as a choice between 2 very different kinds of bets. It's a choice between being the player or being the house.
And here's the fundamental difference. On one side, you've got people who buy options. They have a low probability of success, but if they hit it big, the reward can be massive, kind of like a lottery ticket. On the other side, you have the options sellers. They have a high probability of making a profit, but their reward is capped. They aren't gambling, they're acting like an insurance company, just collecting those steady premiums. And these graphs show that difference so perfectly. Look at the one on the left for the option buyer. They need a huge move in the market just to make a profit. But now look at the one on the right for the seller. They make their maximum profit as long as that huge move doesn't happen. They literally win from things staying relatively calm and just letting time pass.
And that leaves us with a final, really important question. When you look at your own investing strategy, are you trying to predict the future or are you playing the probabilities? This book makes a pretty compelling case that shifting your focus from one to the other could make all the difference.
You ever wonder how some people get their start in investing? Well, today, we're going to dive into an incredible personal story about how one simple gift kicked off a 24-year investing journey, one that's packed with lessons on grit, partnership, and, the power of just getting started. So, let's start with a question. What kind of gift could you possibly give a 14-year-old that sparks a 24-year investing journey? I mean, really think about that. It's not what you'd expect, right? Not stamps, not coins, something totally different. Turns out, it was a single share of stock. That's it. His mom gave it to him way back in the 80s, and that one simple gift, well, that was his first real peek into the whole world of the stock market. And the company? It was Reebok. I mean, a huge brand back then, for sure. That one share was trading for about $20. Now, $20, it doesn't sound like a fortune, but for a teenager, that was everything. It was a real, actual piece of a company he could say was his. And you better believe he followed it. This was way before you could just pull up an app on your phone, right? He had to grab the local newspaper every single day and find the stock listings. Can you imagine the thrill when, a few years down the line, he sold that one share for $40? He doubled his money. That first little win, that was the spark that lit the fire. But look, as we all know, one small win isn't enough to make you an investor. It just isn't. You've got to have the right mindset. And for him, that came from a couple of really key influences in his life. So, his mom, she kept that curiosity going by giving him business books on, get this, audio tape. And on top of that, he started getting sucked into the world of real estate thanks to those Carlton Sheets late-night infomercials on TV. These little seeds of financial knowledge were being planted from all over the place. But honestly, the biggest influence of all, it wasn't a book, it wasn't some TV show, it was his dad. His father was a completely self-made guy who started from scratch and built a multi-million-dollar business. And his dad's whole philosophy was pretty simple. You are going to face challenges. That's a given. The only way you get through them is with pure, relentless grit. Okay, so with that lesson about perseverance ringing in his ears, he decided it was time to take his first big leap. He's just 22 years old, still in college, mind you, and he jumps headfirst into the world of real estate auctions. So he's at a foreclosure auction, and he meets this experienced investor, a guy named Jim Smith. He just walks up to Jim, starts asking a bunch of questions, and you know what? That curiosity turned into a partnership. The two of them together bought this exact house you're looking at right now. And this picture was taken years later. It's still got the same paint job they put on it all the way back in 1992. All right, so let's get into the numbers of the deal. They picked up the house for $42,000 using what's called a hard money loan. They did some work on it, and then they found a buyer who couldn't get a regular loan from a bank. So they set up their own payment plan, selling it for $62,500. Now, their mortgage was $550 a month, and the buyer was paying them $750. So on paper, hey, that's a nice, simple $200 a month in profit, right? But, and there's always a but, isn't there? This is where that lesson in grit really got put to the test. The new owner, they were never on time with the payments. Never. So you can imagine, this created a massive cash flow nightmare. The lender, who also happened to be a friend, was on the phone with him constantly, asking where the money was. It was just unbelievably stressful and, frankly, super embarrassing for him. Now, the deal did work out in the end. It took about a year, but the new owner finally refinanced and they got paid off, making a pretty nice profit. But you know what? The money, that wasn't the most valuable part of the whole experience, not by a long shot. The real takeaway was a huge lesson about the power of a partner. Looking back, he realized the smartest thing he did wasn't buying the house itself. No, the absolute best move he made was going in with an experienced partner like Jim. Jim's know-how, That was the secret sauce. That's what held the whole thing together when it felt like it was all about to fall apart. And this is so crucial. See, he was the one who was able to get the loan, but Jim had everything else. He had the knowledge, he had the crew to do the renovations, and he had the wisdom to figure out how to handle the whole crisis with the buyer who wasn't paying. There's just no way that deal would have happened without him. It would have been a total failure, for sure. So yeah, that first real estate deal was messy, it was stressful, but wow, did it teach an absolutely invaluable lesson about partnership. And it kind of makes you think, doesn't it? What's the most valuable lesson that a mistake or a really tough challenge has ever taught you? So, have you ever stopped and wondered why so many really smart people, even the professionals, just can't seem to make consistent money in the stock market? We're always told, follow the experts, but what if the experts themselves are kind of playing the wrong game? Okay, let's really dig into this and see what the data has to say. Look, we all work our tails off for our money. We save, we try to build something for the future. But this picture, man, it really hits on a deep-seated fear, doesn't it? What if the path we've all been sold, work hard, save money, give it to the pros, is just broken? What if our whole approach to making a living is flawed from the get-go? To really get our heads around this, let's borrow a framework from a name you've probably heard, Robert Kiyosaki. He boils down every way you can earn income into just 4 buckets, and this is going to help us see exactly where the problem is for most of us. Okay, so this is where it really clicks. Kiyosaki lays out these 4 quadrants. First, you've got the employee. You're trading your time for a paycheck. Simple. Then, the self-employed. You're your own boss, sure, but if you stop working, the money stops coming in. Even the business owner, they're often tied down by the day-to-day grind. You see the theme here, right? All 3 of these require you to be actively working. That just leaves one more, the investor. And this leads us to a really blunt, really powerful point from the source material. If what you are truly after is passive income, money that flows in while you sleep, then those first 3 paths just are not designed to get you there. It's a hard truth. So after all that, there's really only one option left on the table for generating real, hands-off passive income: becoming an investor. And for most people, the most common way to do that is, of course, the stock market. But this is where things get really messy. And boom, that drops us right into the world of the market experts. The people all over TV and the internet who claim they have the crystal ball, that they know exactly where the market is going. But let's be real. Is that even possible? This is the core myth we've got to bust open. I mean, this is the question that just freezes so many people, isn't it? It feels like you're walking into a casino. You put your hard-earned cash on the table, and you just have to guess, up or down. It seems like the whole entire game is about predicting the future. And this right here just nails the problem perfectly. When you see an expert talking, they're always eager to show you their greatest hits, right? Their huge wins. But what are they not showing you? All the other trades, the ones that went sideways, the ones that lost money. You're only seeing a tiny, carefully selected slice of the pie. So what happens when we pull back the curtain and look at the whole picture? Let's just forget the hype and the flashy headlines for a minute. Let's look at some cold, hard data on how these professional fund managers actually do when every single one of their trades is on the books. Well, luckily for us, a site called Covestor.com did exactly that. They didn't just look at a few cherry-picked winners. No, they tracked the actual total end-of-the-day portfolio results for 54 different professional funds over an entire year. This is about as real as data gets. And here it is, the result. And honestly, it is absolutely staggering. After 365 days, out of those 54 professional funds, a massive 89% of them were unprofitable. Let me say that again. They lost money. Only that tiny little sliver, just 11%, managed to end the year with a profit. Just let that number sink in for a second. 11%. That's the success rate for the pros, the people whose entire job is to predict where the market is going and make money doing it. Let's put it another way. That means roughly 9 out of every 10 of these expert portfolio managers who base their strategy on picking a direction failed. The strategy just doesn't work, and the data is screaming it at us. All right, so if the experts can't do it, you're probably thinking, well, what hope do I have? But this is where we need a total mind shift. What if the goal isn't to guess the direction in the first place? When you actually look at the history, the market goes up about 53% of the time and it goes down about 47% of the time. Think about that. The odds are so close to a coin flip, it's almost scary. So the secret isn't getting better at guessing the coin flip. The secret is finding a way to make money, whether it lands on heads or tails. Now that is a totally different way of thinking. So let's bring it all the way back to our original mission here, passive income. This is the holy grail. It's about building a system, a machine that makes money for you, not giving yourself another stressful full-time job where you're just biting your nails and guessing all day. So we're left with this one last and maybe most important question. If trying to predict the market is a fool's game, what's the alternative? Is it actually possible to profit consistently without having a crystal ball? The answer lies in strategies that don't depend on seeing the future. And that is the real key to unlocking the kind of passive income we're all searching for.
Look, we all want to do the right thing with our money, right? Especially when we're thinking about the long term. And a lot of us, we turn to experts for a little guidance. But what if I told you that some of the most popular advice out there, even with the best intentions, might actually be costing you a lot? We're about to dive into a real-world example that shows you just how much.
It's a tough question to ask yourself, isn't it? You might be following a plan you totally believe in, something that feels safe and smart, but how do you really know if it's working as hard as it could be? Today, we're going to follow the money and see what happens when a very common strategy gets put to the ultimate test.
So this whole thing kicks off with a story that probably sounds super familiar. A friend is asking about how to invest for retirement. You know, it's a conversation we've all had or will have. He's just trying to do the smart thing, set himself up for the future. And so he turns to a very, very well-known financial guru for game plan. And the advice he got came from Dave Ramsey, a huge name in personal finance. The recommendation was pretty straightforward. Invest in 5 different low-fee mutual funds. Now, if you don't know, a mutual fund is basically just a big basket of stocks managed by a professional. On the surface, it sounds like a great strategy. You're spreading your money out, managing risk. What could go wrong?
All right, so here they are. These are the 5 funds that made up the portfolio. You can see there's a mix of stuff in here. International stocks, funds that focus on smaller companies, that's small cap, medium-sized ones, or mid-cap, and of course, the big guys, the large-cap companies. This was the expert-approved plan. But the real question is, did it actually work?
So, to find out if it worked, we have to do something that every single investor should be doing. We have to compare its performance to a benchmark. Seriously, without a benchmark, you're just flying blind. You have no clue if your returns are amazing, terrible, or just meh.
And the go-to benchmark, the one pretty much everyone uses, is the S&P 500. Just think of it as a single basket that holds stocks from 500 of the biggest, most successful companies in the U.S. By comparing our hand-picked portfolio to the S&P 500, we can see if all that work of choosing individual funds was actually worth the effort.
Okay, so let's look at the actual numbers here. Focus your eyes on that 5-year column. That's the average return per year. Now, the Aldra fund, it did pretty well, right? 11.41%. But then look at the S&P 500 benchmark, 11.58%. So, out of these 5 professionally managed funds, only one even came close to beating a simple market average. And that, right there, is our first big clue.
So a slight difference in percentages is one thing, but what does that gap mean in terms of actual money, real dollars? The analysis ran a simple test. What if you invested a hypothetical $40,000? We're going to see what happens when you put $10,000 into 4 of these funds versus just putting the whole $40,000 into a simple S&P 500 index fund over the same 5 years.
And here's the breakdown. You can see exactly how each $10,000 investment grew over those 5 years. The total for the whole managed portfolio is there at the bottom of that first table, and then right below it, you can see the result for that one simple investment in the S&P 500.
And here we go. This is the final score. After 5 years, that portfolio of expert-picked mutual funds, it grew to just over $58,000. Hey, not bad. But that single passive S&P 500 index fund, it grew that same $40,000 to over $71,000. That is a huge, huge difference.
$13,079. Let that sink in for a second. That is the exact amount of money that was just left on the table. That is the real cost of following this specific expert advice instead of just buying the whole market. It's a pretty powerful and honestly, eye-opening number. Now, the point of all this isn't to pick on one financial personality. Not at all. It's about learning the universal lesson this story teaches all of us, no matter who we are as investors. So what's the big takeaway from all this? All right, so here's what we learned. First, you have got to compare your investments to a benchmark like the S&P 500. Think of it as your financial reality check. Second, just because you own a bunch of different funds doesn't automatically mean you're going to beat the market. Third, even expert advice needs to be verified. Think of it as a helpful suggestion, not gospel. And last but definitely not least, do not underestimate simple, low-cost strategies. They can be incredibly hard to beat. You know, when you strip it all away, this really comes down to one simple thing: empowerment. It's about having the tools and the knowledge to look at your own portfolio and know for sure how it's actually doing compared to the rest of the market. That knowledge, that's your most valuable asset.
So I'm going to leave you with a question to think about. After seeing all this, take a real look at your own investments, your retirement accounts. Do you even know what your benchmark is? And more importantly, are you beating it?
Passive income. I mean, that's the dream, isn't it? Making money while you're not actively working. But actually getting there, well, it can feel like you're lost in a maze. And worse, you've got all these people shouting that they have the one true map. So the real challenge here isn't just about the money. It's about finding a guide you can actually trust. And that's exactly what we're going to break down.
You know, most people think the biggest thing holding them back from passive income is money, or, just not having enough time. But what if the real barrier is something totally different? What if the school you need to go to is basically closed to the public, and you didn't even know you were supposed to sign up? Because the key that unlocks this whole thing, it isn't cash, it's knowledge.
So here's our game plan. First, we're going to dig into that learning barrier that trips everyone up. Then we'll take a walk down the guru's shortcut, which looks tempting, but it's treacherous. We're going to pull back the curtain and expose the trick. After that, we'll see what makes a real mentor so different. And finally, I'll give you a simple way to see the whole picture for yourself, so you can make way smarter choices.
All right, let's jump right into part one, the learning barrier. This is all about that huge wall we all seem to hit, and why just taking that first step can feel like the toughest part of the entire journey.
It's funny, because it really doesn't matter what path you're looking at. Real estate, stocks, starting an online business, you name it. Every single one has this one thing in common. This brick wall right at the beginning. And it's a simple fact. Before you can earn, you have to learn. And figuring out how to get over that barrier is the first real challenge for everybody.
A really good way to think about this is, it's like learning to drive a car. You can't just jump behind the wheel and hope for the best, right? First, you got to learn the rules of the road. Then you have to actually practice so you can pass the test. And hey, even after you get your license, you still need to know some basic maintenance to keep the car from breaking down. It's a clear process with steps you just can't skip. But what if someone came along and said you could?
And that's where the temptation really kicks in. Which brings us right to our second section, the guru's shortcut. It's a path that looks so easy, so appealing, but it's often incredibly dangerous.
And this is where you really have to be on your guard. The idea of a perfect system is so powerful. Gurus are absolute masters at selling you the destination, that dream of financial freedom, while staying very, very quiet about the real journey. They claim they've cracked the code, and they're offering you this magic key to just bypass that whole learning process we were just talking about. So, it's time to pull back the curtain. Welcome to part 3, Exposing the Trick. We're going to break down exactly how these guaranteed winning systems are faked and reveal the illusion they're built on. This is the million-dollar question, isn't it? I mean, if this stuff is so hard, how do these gurus always show up with a track record that looks absolutely flawless? Well, the method they use is surprisingly simple and, honestly, pretty cynical.
Okay, here's exactly how the trick works. The guru opens 2 different accounts. In account A, they'll make a bet that a stock will go up. So let's say they buy $5,000 worth of GE. Then, at the exact same time, in account B, they do the complete opposite. They bet that the stock will go down by shorting $5,000 of GE. You see what just happened? They've guaranteed that they're going to be right no matter which way the stock moves.
And this is the beauty of the deception. I mean, a stock can only really go up or down. So if G's stock price rises, account A is a winner. If G's price falls, account B is a winner. It is mathematically impossible for them to lose because they bet on every single outcome. They didn't predict anything. They just played both sides.
And here it is. This is the absolute key to the whole illusion. You never, ever, ever get to see the losing account. It just gets deleted, totally erased from the story. The guru takes that one winning account, shines it up, and presents it to you as proof of their genius system. They probably just broke even, but they've successfully created a perfect-looking track record they can sell.
So if that's the trick, what's the real deal? This brings us to section 4, the mentor difference. Let's look at the transparent alternative, which is the complete opposite of what we just saw.
A real mentor is not a salesperson. They're defined by two things that are absolutely critical. A proven track record, and I mean a real, verifiable one, not something manufactured, and genuine expertise in their field. They aren't selling you some secret, they're teaching you a skill that they themselves have actually mastered.
And this really is the fundamental difference, right here. A guru hides almost everything. They show you misleading results to sell you a system. A mentor, they do the exact opposite. They show you the entire portfolio, the wins and the losses. They trade with real money, and they're totally transparent because their goal isn't to sell you a thing, it's to give you an education.
And that brings us to our final section, seeing the whole picture. You should think of this as your last line of defense, the one simple check you can perform before you trust anyone with your time and money.
And this is why this whole distinction is so important. The biggest irony is that finding a true mentor is the real shortcut, not because they have some secret formula, but because they speed up your learning curve. They help you avoid all the mistakes they already made, so you can build real, solid knowledge for yourself.
So the next time you see someone promising you the moon with incredible returns, just pause for a second and ask yourself this one very simple question. Am I seeing the whole portfolio, the wins and the losses? Because demanding that kind of transparency is the single best way to tell the difference between the gurus selling a fantasy and the mentors who are actually ready to share some real wisdom. All right, so today we're going to unpack a really cool origin story. It's not about some crazy complex formulas or anything like that. It's actually about one person's quest to find a better way to invest. And, it all started with this single, powerful feeling.
And it all kicks off with this. Just 3 little words. I wanted more. So simple, right? But it's also incredibly powerful. And I think it's a feeling a lot of us can relate to. You know that feeling when things are pretty good, but you just know there's another level of freedom, of fulfillment out there? Well, that single phrase, that's the engine that drives this entire story.
So let's meet the guy at the center of all this, Karl Domm. And listen, by any normal standard, this guy was already a success. I mean, he had a business degree, he was running a multi-million-dollar company, he was crushing it in real estate. Plus, he's a married father of 4, he'd built a really comfortable life for his family. But, and this is the key part, despite all of that, he just wasn't satisfied. And that feeling, that dissatisfaction, it sent him on a search. But he wasn't just chasing more money, not really. He was hunting for something very specific, passive income. A way to provide for his family, to lock in their lifestyle, without having to be chained to the daily grind of a typical business. Okay, so as he started looking into different business ideas, he just kept smacking into the same 2 walls. Every single new venture needed, 1, a ton of money up front, and 2, maybe even more important, a massive amount of his time. And look, as a husband and a dad to 4 kids, those were 2 things he just did not have to spare. It was a non-starter. So with those traditional business ventures pretty much off the table, where do you go next? Well, he turned his attention to the markets, and this kicked off a really long period of experimentation. We're talking about a journey that would stretch out for almost 2 decades, as he just tried to figure out, hey, could this be the answer I'm looking for?
And I mean, just look at the timeline here. This is wild. He started dabbling in stocks and options way back in 1993. And for a full 18 years, get this, he called it just playing in the market. This was absolutely not some get-rich-quick, overnight success story. It was a long, slow, grinding process of learning.
Now, throughout that really long experimental phase, one huge lesson kept popping up. He discovered this fundamental challenge, right? A core problem that just seemed to make consistent success feel, well, just out of reach. And what was it? It was the problem with investing only in stocks. He actually gave this challenge a name, the directional dilemma. And he really came to see traditional stock picking as this almost impossible game, like a puzzle that was just fundamentally broken right from the start.
So here's the crucial point, right? Investing in stocks is what's known as a direction play. It's basically a 50-50 bet. You only make money if you guess right. Is the price going up or is it going down? That's it. Your entire success hangs on being right about that one single thing. And, in his own words, this is the conclusion he landed on after all those years of trying. He said, "I found it impossible to pick a stock's direction and to be profitable." He realized it was pretty much impossible to do that consistently and build a reliable, profitable system around it. It was a game he just felt like he could never, ever win. But you know what? That frustration, that feeling of just constantly hitting a brick wall, that's actually what led to the big breakthrough. He started looking for a totally different way to win, which brought him to what he calls the options revelation. And this, right here, this is the turning point of the whole story. He started asking a totally new kind of question, a what-if question. Like, what if the whole premise of the game is wrong? What if you could just take the need to predict direction right out of the equation? What if winning didn't have to depend on being right about up or down? And this is the aha moment. He realized it doesn't matter if the market is going up or going down. As he dove deeper into options, he saw it was possible to set up trades where the market's direction just became way less important. He saw that with options, you could make money from other things, like the simple passage of time or a stock just staying within a certain price range. So this totally changed how he saw things. You've got two ways to invest, right? On one side, you have stock investing. That's a direction play. You're betting this stock is going to go up. But on the other side, you have options investing. And with options, you can make a totally different bet. Your bet could be, I think this stock is going to stay between this price and that price for the next month. So you can sell an option, collect the cash up front, and if you're right, you just keep it. You're profiting from stability, not direction. It was a complete paradigm shift, exactly what he'd been looking for. Now, this wasn't just some interesting little theory for him. No way. This was the spark that lit a fire. It was the moment he decided to stop just playing around in the market and start building a real, actual business around this new way of thinking. So when you add it all up, his journey took over 26 years. 26! And that number is so important because it just shows you the depth of experience we're talking about here, especially when you remember that long 18-year stretch of just trial and error before he even decided to get serious about it. And so, in 2011, almost 20 years after he first started, he finally made the switch. He went all in. He committed himself fully to options trading and started treating it like a real business, with the same focus, the same discipline, the same seriousness he used to run his big company. All right, so let's wrap up with the key takeaways from this journey. What have we learned? Well, first, it all started with a really relatable desire, right? Just wanting more time and more financial freedom. Second, the solution wasn't some quick fix. It took years and years of trial and error. And maybe most important of all, the big breakthrough only happened because he was willing to challenge a fundamental assumption that pretty much everyone else just takes for granted. And that really leaves us with one final thought to chew on. Karl's story is about trading. Yeah, but the lesson is so much bigger than that. He didn't find his answer by just trying harder at the same old game. He found it by figuring out how to play a completely different game. And it really makes you wonder, doesn't it? In our own lives, what problems are we trying to solve where maybe just a simple change in perspective could unlock the exact solution we've been searching for all along? Have you ever wished you had a crystal ball for your trades? Well, today, we're going to dive into a tool that's pretty much the next best thing for options traders. It's called the risk graph. And trust me, it's less of a boring old chart and more like a treasure map to your potential profit and loss. So let's see how this thing actually works. Our journey today starts with a search. And I'm not talking about a quick Google search. This was an intense, 6-year-long quest by one trader to find a trading system that was actually consistently profitable. It was a real marathon of trial, error, and, well, a whole lot of patience. And this was no casual experiment. We're talking about a massive, massive effort. Think about it, developing and testing 198 different trading models from scratch. Every single one was a new idea, a new hypothesis, a potential key to unlocking those consistent profits. And each one was put through the ringer. Now here's where it gets really interesting. The failure rate. Out of those 198 models, a whopping 154 of them just didn't work. They didn't make any money, so they were tossed out. It just goes to show you how many roads in trading can lead to a dead end. Brutal. So after months and months of digging through data, the field started to narrow. Out of nearly 200 ideas, only 17 showed enough promise to move on to the next stage. and that meant testing them with real hard-earned cash on the line. This is where theory meets reality. And you know what? Out of those 17 contenders, only 8 actually survived that trial by fire. Just 8. From almost 200 initial concepts, it all boiled down to just 8 that proved to be profitable in the real world. That's a pretty stark reminder of how tough it is to find a winning strategy.
And this quote just sums it all up perfectly. That 6-year marathon ended with just a handful of elite strategies. These weren't just random wins. They became the very foundation of a low-risk, profitable portfolio. The long search was finally over.
So, what was the secret sauce? What did these 8 winning strategies all have in common? What was the key that let this trader navigate the crazy complexities of risk and reward so well? You know, it wasn't some super complex algorithm. It was a surprisingly simple, powerful visual tool.
Yep, it all came down to one essential tool. A tool so powerful that without it, you're kind of flying blind in the world of options. So what was it? What was this key that unlocked a whole new level of clarity and control?
It's the risk graph, and put simply, it's a picture of your profit or loss. It shows you clear as day what's going to happen to your money as the price of a stock moves up or down. No more guessing, no more hoping, just a clear, visual map of the future.
But you know, a map is only useful if you actually know how to read it, right? So let's pop the hood on a typical risk graph. We're going to break it down piece by piece and see what it's really telling us.
Okay, so let's break this down. What you're looking at here is a risk graph for what's called a 4-legged options position. Don't worry about the name, it just means a strategy with 4 different parts. The important stuff is this. The vertical line, the y-axis, that's your money, profit or loss. The horizontal line at the bottom, the x-axis, that's the stock price. And that flat black line in the middle, that's your break-even point. Simple.
Okay, now lean in close because this is where the magic happens. See those 2 curvy lines? They are everything. The purple one, called the T+0 line, shows your profit or loss right now, at this very second. The blue line shows your potential profit or loss way out in the future at expiration. That gap between them, that, my friends, is the power of time.
And knowing the difference between your profit now and your profit later is the whole ball game. So let's apply this to a real example and see how you can read the story this graph is telling us about our money.
All right, to make this super clear, we've gone ahead and added some red lines to act as a guide. The vertical red line marks the current price of the stock. The horizontal ones will help us pinpoint the exact profit or loss. Now let's just follow these lines and see what they tell us.
So let's walk through this together. First, we find the current price, which is right around $2,788. Now, if you trace that line up to where it hits the purple line, our right now line, you can see we're sitting at a profit of about $200. Not bad. But if we keep tracing that same price line all the way up to the blue future line, we see a potential profit of around $5,800. Instantly, we know where we stand today and where we could be later.
You see, this is so much more than just staring at a chart. This is about completely changing how you understand a trade. It's about seeing all the possibilities, the good, the bad, and the ugly, laid out right in front of you. It quiets all that emotional noise and lets you just focus on the facts. Really, the true power of the risk graph is how it takes all that complicated data, strike prices, volatility, time decay, all that stuff, and it translates it into a simple visual story. In one single glance, you can see your best case scenario, your worst case scenario, and everything in between.
And that really leaves us with one final thought, doesn't it? This tool gives you a snapshot of potential futures. It takes away the guesswork and lets you plan your moves like a chess master. So, the real question is, if you could see the possibilities of tomorrow with this kind of clarity, how would that change the decisions you make today?
Have you ever felt totally stuck trying to learn something really, really difficult all on your own? Well, this is a story about that exact struggle. It's set in the super complex world of options trading, but trust me, the lesson here is for everybody. It's all about the incredible power of switching from learning alone to learning with the best. So, this is right where our story kicks off, with a pretty blunt admission of failure. This quote, it just perfectly captures that frustration of trying to find your way through a huge challenge without a map. And, that's a feeling a lot of us can probably relate to. So, how did it even get to that point? Well, the first chapter of this whole journey can really be summed up in just 3 words: trading in the dark. Okay, just let this number sink in for a second. 21. That's how many years were spent trying to figure out options trading, all by himself. I mean, that's more than 2 decades of just going it completely solo. And for all that time, the strategy was basically this lone wolf approach. No mentors, no one to bounce ideas off of, just endless trial and error. He'd come up with ideas, try them out, and pretty much always end up with the same frustrating result: big losses. Now, you definitely don't need to be a trader to get what's going on here. This is called a risk graph. It's a tool for mapping out all the potential profits and losses. But just look at it. It's so complex. This is basically a picture of the maze he was trying to solve, all by himself. So after 21 years, it was pretty obvious that the lone wolf thing was just a dead end. And that realization kicked off the next and maybe most important phase of the journey: the active search for a real system. This timeline, it really shows the turning point. After 21 years of isolation, you see that first step into a community in 2014. And then, just 2 years later, that leads to finding this super vetted, expert-level group. You can literally see the path from being alone to working together. So that first step in 2014, that was discovering tastytrade.com, which is this online financial network. And it was great, a fantastic resource for learning the basics of risk and strategy. But even after a couple of years, it was clear that just knowing the information wasn't enough to actually succeed. Something was, well, it was still missing. And the search that followed was, well, incredibly thorough. This was not a blind leap of faith at all. He systematically went through and vetted around 30 different online gurus. And out of all of them, you want to guess how many had real, provable merit? Just one. And finding that one credible expert, that was the key. It was the thing that unlocked this entire next chapter. It led to the discovery of what's called a mastermind group. You see, the ultimate solution wasn't another book, it wasn't another course, it was people. After taking an advanced course with that one expert he found, Ron Bertino, he got an invitation to join an exclusive mastermind, a peer group totally dedicated to helping each other grow. It was a community made up of the other graduates from that same course. And the people in this group, wow, they were at the absolute top of their fields. This was not some beginner's chat room. We're talking millionaires, finance professors, former market makers, aerospace engineers, coders, Ivy League grads, hedge fund managers, and even other options trading gurus. This was a true collaboration of experts. And this right here, this is where the story shifts from being about one person's trading journey to a powerful, universal lesson for every single one of us. So let's break down why this kind of collaboration is such a massive game changer. So, what's the secret sauce here? What is it exactly that makes a group of diverse experts so much more powerful than just trying to learn everything on your own? Well, it's about getting real-world answers to the really critical questions, the kind of stuff you just can't learn from a book. You know, things like, how big should my position be? What do I do when my system just stops working? What's actually the best way to backtest an idea? These are the nitty-gritty, practical problems that a community of experts can just figure out together. And that brings us to the single biggest lesson from this whole story. The main takeaway is this: if you genuinely want to master something complex, the fastest path is to find and join a collaboration of experts, period. Because when you find that group, your progress stops being this slow, plodding, step-by-step thing. It becomes exponential. That upfront effort to find the right people pays off big time, and all the hard work you're putting in finally gets rewarded. So we'll leave you with this one question. Forget about trading for just a minute. Think about your own goals, your career, maybe a skill you're trying to learn, a hobby you love. Where in your life could finding the right group of experts be the one thing that just accelerates everything? All right, let's talk about something we've all felt. You look at your portfolio's return and you think, okay, is this actually good? Well, you are definitely not alone. Today, we're going to cut through all that complicated jargon and get to a single, really powerful ratio. It was designed by a trader, and it measures what truly matters, the reward you're actually getting for the risk you're taking. So, really, what is the real score of your portfolio? I mean, which is better, a super volatile 15% gain or a nice and steady 8%? The usual ways of measuring this stuff can be, well, they can be super confusing. We're going to focus on something much clearer. We're talking about the relationship between your return and the actual risk you had to stomach to get it. Okay, so here's the game plan for today. First, we're going to tackle that jungle of confusing metrics. Then, I'll show you a super simple ratio that just cuts right through all that noise. We'll even put it to the test with a real example, talk about where it falls short because nothing's perfect, right? And then, the best part, show you how you can use this to make way smarter decisions about your own money. All right, first things first, let's talk about the problem. You know, if you've ever tried to figure out how to measure your portfolio's performance, you've probably just been slammed with this wall of confusing financial jargon. It's a massive headache and, honestly, a super common frustration. I mean, the financial world is just filled with these things, right? You got the Sharpe ratio, the Sortino ratio, Kalmar, value at risk. The list just goes on. And a lot of them lean on these really complex statistical ideas like standard deviation, which, let's be honest, can be kind of hard to wrap your head around. And they don't always capture the real-world risks, that gut-wrenching feeling you get month to month. And that's exactly where the author of this idea comes in. He's super clear about this. He says, look, the point here isn't to rehash some academic textbook. It's about giving you real, practical principles that come directly from his own trading experience. So he's offering a tool that actually works, in the trenches. So, okay, if all those old-school metrics are the problem, what's the solution? Well, this is it. The author suggests a really simple ratio that's designed to slice right through all that complexity. He calls it his risk-reward ratio. And honestly, it's brilliant in its simplicity. All it does is compare your portfolio's annual return to its worst single monthly loss, its biggest drawdown during that same period. That's it. No crazy formulas, just two numbers that tell a really powerful story about your performance. So here's the formula, and it's super straightforward. You just take your annual percentage return and you divide it by your lowest monthly drawdown. That final number, it tells you exactly how much return you got for every unit of risk you had to endure during your absolute toughest month. Okay, theory is one thing, but let's see how this thing actually performs in the wild. We're about to put it to the test in a head-to-head comparison between two different portfolio managers. Let's find out who really did the better job. All right, here are our two contenders. On one side, we have Manager A. They got a 13% return for the year. Pretty good, but they had one really painful month with a 7% loss. Then there's Manager B. They earned a little less, just 9%, but their worst month was only a tiny 2% dip. So, who actually had the better year? The answer might not be what you think. Okay, let's run the numbers for Manager A. We take their 13% return, divide it by that 7% drawdown, and that gives them a risk-reward score of 1.86. Okay, 1.86. Remember that number. Now let's do the same for Manager B. We take their 9% return and divide it by that really small 2% drawdown. And wow, their score comes out to 4.5. A completely different story, right? And this chart really just lays it all out. Even though Manager B had the lower return on paper, their risk-adjusted performance was just way, way better. Their score is more than double Manager A's. It means they gave their investors a much smoother ride and way more bang for their buck, risk-wise. So, the big question is, why does something this simple work so well? I mean, it seems almost too easy. Let's break down the logic behind why it's so effective. Okay, there are really three key reasons this works so well. First, it's just fast and easy. Anybody can calculate it in seconds. Second, and this is the really important part, it focuses on the actual pain you felt during your worst month. It's not some abstract average volatility, it's the real deal. And third, that focus is absolutely vital because those real-world drawdowns are what gets you into trouble. They can trigger margin calls. They can force you to sell at the absolute worst time. This metric at its core is about survival. But, like any tool, it's not a silver bullet. It's not perfect. So to use it the right way, we really have to be honest and talk about its limitations, the specific times when it just doesn't work. And the author's really upfront about this, which is great. He points out that to use this thing effectively, you have to know where it breaks. There are two key flaws you've got to be aware of. So here they are, the two situations where the math just falls apart. Scenario 1, if your portfolio actually lost money for the year, the ratio just doesn't give you a meaningful number. And scenario 2, which is a great problem to have, by the way, is if you never had a single losing month. You can't divide by 0, so the calculation just won't work.
Okay, so now for the really practical part. How do we take this cool little ratio and actually put it to work? In this last section, we're going to connect this idea directly to making smarter decisions in your own portfolio.
This quote from the author really just nails the whole point. Your goal is to have no surprises when it comes to drawdowns. That's it. It's about understanding the real risk you're taking so that when that bad month finally does come around, and it will, you're actually prepared for it. And this leads us to the ultimate payoff: smarter position sizing. Once you know a strategy's real-world worst-case drawdown, you can make much better decisions about how much money to put into it. For instance, if you know a particular strategy has had a 10% worst month in the past, you can ask yourself, okay, how much of my capital am I really comfortable exposing to that kind of drop? It helps you avoid going all in and facing a potentially catastrophic loss.
So when you boil it all down, it really comes to one single crucial question. And this is what I want to leave you with. Is your portfolio prepared for the actual worst-case scenario? Or are you just sort of hoping for the best and relying on some comfortable average? Thinking about that honestly, well, it could completely change the way you invest.
All right, let's dive right in. We're going to be shattering some of the biggest myths in trading today. We're talking about the core principles that really separate the professional traders from everyone else. What they know that, well, most of us just don't.
You know, this quote really gets to the heart of it all. True expertise in trading isn't about some secret formula for picking winners. No, it's about learning from all the painful, expensive mistakes. It's about building this massive mental checklist of what not to do. That's where the real wisdom is.
So, here's how we're going to break it all down. First, we're going to tackle something called the Great Diversification Lie. Then, we'll get into the absolute foundation, your personal trading plan. After that, we'll uncover the hidden costs that just chew up your profits. And finally, we'll pull it all together by mastering trade execution.
Okay, let's start with the big one, the Great Diversification Lie. We've all been told that spreading your money around is the safest way to invest, right? Well, we're about to see why that supposedly safe portfolio might just be a ticking time bomb.
I mean, take a look at this. On the surface, this portfolio looks fantastic, doesn't it? You've got the whole market with the S&P 500, you've got tech, aerospace, retail, airlines, oil, biotech, all totally different sectors. By the book, this is exactly what a safe, well-diversified portfolio is supposed to look like.
Everything seems great until it's not. And that brings us to the million-dollar question. What happens when everybody, and I mean everybody, starts to panic at the same time? And here's your answer. This is what happened to those exact stocks on one really bad day, February 5th, 2018. It's just a sea of red. Nvidia got hammered, down 12%. Boeing, down over 9%. Everything went down. All that diversification that was supposed to be your safety net, poof, gone.
Here's actually a name for this. It's called crash correlation. See, when panic hits, people don't stop to think. They just sell. They sell everything to run for the safety of cash. And that safety you thought you had in all those different sectors, it vanishes right when you need it the most. It's a massive hidden risk.
So, if diversification can fail you in a panic, how do you protect yourself? Well, that brings us to our second point. You have to have a personal trading plan. This, right here, is the real difference between investing and just plain gambling. And look, a real plan isn't some fuzzy idea in your head. It's having clear, specific answers to these questions before you even think about clicking the buy button. When are you going to admit you're wrong and just take the loss? How much are you willing to risk on this one trade? How long are you planning to be in it? How big is your position going to be? And just as crucial, when do you take your profits and walk away? You know, the biggest mistake a plan saves you from is making emotional decisions. Without a set of rules, it's just human nature to bet too big and then hold on to a losing trade for way too long, just hoping and praying for a comeback. Your plan is your defense against your own worst instincts. A lot of people skip the planning part because they're too busy hunting for that magic indicator that's going to predict the market's every move. But do those things even work? Well, after a 26-year study of all of them, the success rate turned out to be just 50%. That's right. Moving averages, stochastics, Elliott wave, you name it. After testing everything, the result was no better than a simple coin flip. So, what does that tell you?
It tells you that your real edge isn't going to come from predicting the future. It comes from having a solid plan to manage your risk, because you're going to be wrong about half the time. That's just a fact.
Okay, so having a plan is absolutely critical. But even the best plan in the world can get derailed by our third topic, hidden costs. These are the little invisible things, like fees and something called slippage, that can just silently eat away at all your hard-earned profits. It all starts with how you place your order. With a market order, you're guaranteed to get into the trade, but you have no idea what price you'll get. You might end up overpaying. A limit order, on the other hand, lets you name your price, but you might miss the trade completely if the market moves away from you. It's a classic trade-off you have to navigate. Now, that little difference between the price you thought you were getting and the price you actually paid, that's called slippage. And it's not some broker fee, it's a direct loss. It's money coming right out of your pocket on that trade, and believe me, it can add up to a fortune over time, especially with market orders. And then there are commissions. Just look at this chart. This shows the fee to trade the exact same amount of the S&P 500 using 3 different products. Trading options on the SPY ETF costs you $6.50. Trading futures with /ES costs $2.40. But trading options on the SPX index itself, just 65 cents. Just by picking the right product, you can slash your commission costs by over 90%. That's huge. Okay, so all of this brings us to the final piece of the puzzle, the thing that ties it all together: mastering your trade execution. This is that final technical step that really separates the pros from the amateurs. So, when you're doing complex strategies, the ones with multiple parts or legs, a lot of traders try to put them on one piece at a time. This is called legging in, and honestly, it's one of the riskiest mistakes you can possibly make.
Here's how it always goes wrong. First, your first order fills. Boom. Now you're exposed to the market with only half a trade on. Then Murphy's Law kicks in, and the market immediately moves against you. You're losing money before you're even fully in the position. Now you're panicking, and you rush to get that second order filled, which means you get a terrible price and pay a ton in slippage. A trade that looked perfect on paper is now a loser from the get-go.
So what's the pro move? What do they do instead? It's actually way simpler. They use what's called a single-ticket order. You basically package the whole complex trade into one single order that has to get filled all at once at the price you want, or not at all. Think about it like buying a used car. If you offer $9 grand for a $10,000 car and the seller immediately says yes, you're going to kick yourself thinking you could have gotten it for less. But if you make your offer and they have to think about it for a week before saying yes, then you know you got the best price possible. A single ticket order is like making that patient, confident offer to the market. The advantages here are massive. You completely eliminate that risky gap between the legs. You slash your slippage. You force the market to come to your price, not the other way around. And you can even set it and forget it with an order that stays open until it gets filled, whether you're at your computer or out living your life. So this all really comes down to one final, crucial question you've got to ask yourself. Is your strategy designed to avoid these kinds of silly, unforced errors, or is it just built to chase profits? Because what the pros know is that long-term success isn't just about offense. It comes from playing great defense.
So if you're an options trader, doesn't matter if you're just starting out or you've been doing this for years, you have to make one big choice, right? Are you a buyer or are you a seller? Today, we're going to dive into a professional's guide to that exact question. We'll break down the risks, the rewards, and maybe most importantly, the hidden edge that really separates the pros from everyone else. So let's get into it, starting with a weird little paradox right at the heart of this whole thing. Think about that for a second. What if the strategy that has the absolute highest chance of making you money is also the one that could wipe you out completely? It sounds kind of crazy, right? But that's the central conflict in options trading. And if you don't understand it, well, you're going to have a bad time. Okay, so this is ground zero. Are you buying premium? Betting on a huge move? Or are you selling it, basically betting that things are going to stay pretty chill? These are two totally different mindsets, two different worlds with completely opposite philosophies. And what I love about this slide is how it just shows you the whole game in one picture. On the left, that's the option buyer. See how your loss is totally capped? It can't go below that floor, but your potential profit, sky's the limit. Now look at the right, that's the seller. It's a perfect mirror image. Your profit is capped, but your potential loss is, well, unlimited. Let's just break this down real simple. When you're buying premium, you're making a low probability, high reward bet. You're basically buying a lottery ticket. You're probably going to lose, but if you win, you could win big.
Selling premium, that's a high probability, low reward bet. You're not buying the lottery ticket, you are the lottery. You're the casino collecting all those small payments from the people hoping to hit the jackpot. So let's look at it from the buyer's side. You risk a very specific amount of money. In this case, $565. That's all you can possibly lose. Now, you need the stock to make a pretty big move just for you to break even. But if it does, look at that. A potential return of over 1,200%. That is some serious asymmetric leverage.
And now, let's flip the coin. The seller is on the other side of that exact trade. They collect that $565 premium upfront. Their goal? For that option to just slowly die and expire worthless. And most of the time, that's what happens. The odds are in their favor. But if they're wrong and that stock takes off, those losses can get out of control fast.
Okay, so if selling has this terrifying unlimited risk, why on earth would anybody do it? Well, because the pros aren't just flipping a coin. They're systematically exploiting two really powerful statistical advantages that are just built right into the options market. This is the first edge, and it's the most famous one. Every single option has a ticking clock, an expiration date. It's a decaying asset. So if you're a seller, that decay is your friend. You are literally getting paid while the clock ticks down. Right, the fancy term for this is positive theta, but all you need to know is this. For an options seller, theta is your best friend. Every single day that goes by, a little bit of that options value just evaporates, and that value flows right into the seller's pocket, as long as the price doesn't go crazy. Time is literally on your side. And this graph shows it perfectly. Just look at that vertical line in the middle, where the stock price hasn't changed at all. The blue line, right at the beginning of the trade, shows a small profit. But then you just wait. Look at the orange line a few weeks later. Your profit has grown a ton, and the stock price didn't have to do a thing. That's the magic of time decay right there. Okay, edge number 2. This one's a little more subtle. Option prices are based on something called implied volatility. It's basically the market's collective guess, or maybe fear, of how much a stock is going to move around in the future. But that's just a guess. Realized volatility is what actually ends up happening. And spoiler alert, there's usually a big difference between the two. You can see it right here in this graph. The market almost always overestimates how much things are going to move. That red line, implied volatility, is consistently higher than the blue line, what actually happened. And why is that? Because the market prices in a fear premium for worst-case scenarios, like a sudden crash. That gap between fear and reality, that is pure profit for the option seller. So just how consistent is this edge? Well, the data shows that implied volatility is higher than what actually happens a whopping 83% of the time. Let that sink in. More than 4 out of 5 times, options are systematically overpriced. So as a seller, you are consistently selling something for more than it's statistically worth. That is a massive edge. So you've got time decay on your side, and options are usually overpriced. It sounds like selling is a total slam dunk, right? Easy money. Well, this is where we have to talk about the dark side. The trap that sucks traders in and then completely blows up their accounts. The author of the source material for this could not be more clear on this point. When you sell an option without buying another one to protect yourself, what's called naked selling, the risk is just flat out unacceptable. It doesn't matter how small your position is. It's not a question of if you'll get blown up, it's when. And this isn't just some abstract theory. The author shares a gut-wrenching personal story from the 2008 crash. He thought he'd found a sure thing, a foolproof trade, so he sized up, went bigger, and then the market imploded. The options he sold went parabolic against him, and he got the dreaded margin call from his broker, demanding more cash, forcing him to liquidate at a devastating loss. You see, the trap is so seductive. Selling naked makes money faster, and that feels amazing, but it exposes you to that insane asymmetric risk we saw on the graph. And when a crash happens, your margin requirements can literally explode overnight, and that whole idea that you're diversified, yeah, that goes right out the window because in a real panic, everything goes down together. So, this brings us to a hard and fast rule, one that was learned through a lot of pain. To survive in this game as an option seller, you absolutely, positively cannot sell naked options. Period. End of story. It's non-negotiable. Okay, so how do you actually capture that amazing seller's edge without getting totally annihilated? Well,
The pros use a very specific set of tools and rules that are designed just for managing this kind of risk. This is their playbook.
First things first, pros don't use the same margin system that most retail traders do. They use something way more sophisticated called portfolio margin. Instead of just looking at some theoretical worst-case loss at expiration, it runs real-time stress test on your entire portfolio. It's a much, much smarter way to measure your actual risk. So here's a peek at how it works. Your broker's system is constantly running these what-if scenarios. What if the market drops 12%? What if it rallies 10%? It calculates the potential loss in each of these scenarios. And then it takes the biggest potential loss, in this case, that $7,800 loss from a 12% drop, and that becomes your margin requirement.
And just look at the difference this makes. Under the old, regular system, your margin might be $11,500. But with the smarter portfolio margin calculation, it's only $7,800. That's a huge difference. It gives the pros much more leverage and makes their capital way more efficient. So, really, it all comes down to these three core principles for survival. Number one, get the right tool for the job. That means portfolio margin. Number two, don't just guess how big your position should be. Base it on data, on back tests of how the strategy performed in the worst market conditions. And number three, and this is crucial, always leave a cushion. Never, ever let your maximum margin get above 65% of your total account value. So there you have it. We've gone through the fundamental choice between buying and selling. We've uncovered the statistical edges that make selling so attractive. But we've also stared into the abyss of what happens when you do it wrong. And now you have the exact playbook the pros use to do it right. So the question isn't just about buying or selling anymore. It's about whether you're ready to adopt the discipline it takes to manage risk like a professional. Okay, so when you hear the word options, what's the first thing that pops into your head? For most people, it's one word: risk. The common wisdom is that they're complicated, they're dangerous, and they're just a super fast way to blow up your portfolio. But what if that's, well, only half the story? So let's just jump right in, because today we're going to see how options can be used not to add risk, but to actually control it in a really, really powerful way. All right, let's just tackle this head on. Are options just a fancy way to gamble in the financial markets? It's a fair question. It's the fear that keeps a lot of people on the sidelines. But here's a thought. What if we're so busy worrying about the obvious risk that we're completely blind to a much, much bigger danger lurking in just about any portfolio? And that's where we meet the real villain of this piece, something called exponential risk. This isn't just your garden variety market risk. Nope. This thing is leveraged, it's supercharged, and it can cause your account to swing down hard without any warning, especially when the market starts to panic. It really is the monster hiding in the closet. So what is this thing really? Think of it like this. Exponential risk goes from 0 to 100 when the market takes a nosedive. Everyone panics, right? They all rush to buy protection, specifically put options. And that flood of buying, it causes volatility to just explode. And if you're selling options, that sudden spike, man, it can be absolutely catastrophic. It can flip a winning trade into a massive loser, like in the blink of an eye. And this slide right here, it really breaks down the core dilemma for a lot of option sellers. On one hand, you've got theta. That's the good stuff. It's the daily income you collect as time just ticks by. It's your slow, steady paycheck. But on the other hand, you've got the boogeyman, vega. If your vega is negative, it means that when volatility spikes during a crash, boom, the options you sold are suddenly way more valuable, and that creates these huge, totally unexpected losses. It's the ultimate trade-off, steady income versus sudden, devastating risk. Okay, theory is one thing, but let's see this beast in its natural habitat. We're going to hop in a time machine and go back to a very specific day. August 24th, 2015, a day the market had a massive flash crash. We're going to see exactly how this exponential risk can just rip a seemingly safe strategy to shreds. All right, so check this out. This is the before picture. It's a classic iron condor, a super popular strategy for traders who are betting on the market just staying calm, not really going anywhere. And look at that graph. It looks pretty good, right? Nice wide profit zone, your risk is defined. It's built to just sit there and collect that theta we talked about day in, day out, as long as things stay quiet. Yeah, but things didn't exactly stay calm. And wow, does this picture tell a story? Look at that purple line, the T+0 line. That's your profit and loss in real time. See how it's been just yanked downwards violently? And here's the key. It wasn't just that the price moved. It was the explosion in volatility, that negative vega coming back to haunt us, that made the options we sold so much more expensive. Bam! A huge loss, no matter where the stock price actually ended up. So, what was the final tally? A loss of $27,870. Ouch. That is exponential risk in the flesh. A strategy that looked totally fine a few days ago gets completely annihilated by a force that, honestly, a lot of traders just don't see coming. Okay, so that's the scary part. But what if you could actually fight back? What if you could take that exact same destructive force, that spike in volatility, and literally flip it, turn it into your advantage? Well, it's time to meet the hero of our story, a proper hedge. And that hedge has a funny name. We call them Teenies. Now, the name might sound kind of small, but believe me, their impact is anything but. So what is it? It's basically just a super cheap put option, way out of the money. Think of it like crash insurance for your portfolio. And its whole job, its entire reason for being, is to add positive vega to your position, the exact opposite of what we had before, so you can fight back when volatility goes nuts. Okay, now look at this. This is so cool. On the left, our original trade, the naked iron condor. On the right, the exact same trade, but we've added a couple of these Teenies. You gotta look closely, but can you spot the difference? Focus on the far left wing of that purple T+0 line on the right-hand graph. See how it's just slightly lifted up? That tiny little change? That's our shield. That's our positive vega, just sitting there, waiting for trouble. All right, here we go. This is the moment of truth. Let's replay the tape. Same day, same crazy market crash, same base strategy. The only thing we've changed is we've added our little insurance policy, our Teenies. Let's see what happens now. And there it is. Would you look at that? It's incredible. So, the market is tanking, volatility is going through the roof, but look at our profit line. Instead of getting sucked down into that black hole of losses like before, it's actually getting pushed up. That positive vega from our Teenies just kicked in and did its job. It literally turns the market's fear into our protection. The exact same force that killed the first trade is now saving this one. That's the whole ballgame right there. I mean, the difference here is just night and day. On one side, you've got a loss that could literally wipe an account out. On the other side, with just a tiny, smart adjustment, the position is completely protected. This is what we're talking about, really understanding and controlling your risk instead of just being afraid of it. Now, I know what you're thinking. This looks like some kind of financial magic trick, but it's really important to be clear. This kind of powerful protection, it isn't a free lunch. There's a trade-off. There's always a trade-off. It's just like any other insurance policy you'd buy. You know, a really great way to think about this is summed up in this quote. It's like buying fire insurance for your home and never collecting because the fire never happens. It's money down the drain. And that's the psychological challenge, right? These hedges cost money to maintain. And since big crashes are thankfully pretty rare, you're going to spend most of your time paying that premium and feeling like you're just throwing money away. It takes real discipline to stick with it when the sun is shining. And yeah, we have to be honest about the limitations here. First, there's that upfront cost we just talked about. Second, again, these big crashes are rare. But third, and this is a really important one, this type of hedge is designed for a fast, violent crash. It might not help you much in what traders call a grind-down market. That's where the market just slowly, painfully bleeds out over weeks or months without a big spike in fear or volatility. In that case, the market could fall enough to hurt you, but not fast enough to trigger your insurance payoff. And all of this really brings us to the big final question, the one I want to leave you with. Because, this whole thing wasn't really just about iron condors or Teenies. It's about a fundamental shift in how you think. It's about seeing these complex financial tools not just as ways to make a profit, but as powerful instruments for protection. So the real question to ask yourself is this. How can you start using the tools at your disposal, not just to chase the next big gain, but to thoughtfully and intelligently defend the capital you already have?
You ever wish for an investment strategy that just works? I mean, no matter what the market is doing, soaring, crashing, or just going completely sideways, a real all-weather approach. It's kind of the holy grail for us investors. And today, we're going to see if we can find it by putting some of the very best strategies to the ultimate test.
You know, the legendary investor Paul Tudor Jones really said it best. While everyone gets excited chasing those huge, flashy returns, what if the real secret to winning in the long run isn't about how much you make, but about how much you don't lose? That's really the core idea we're digging into today, the power of a good defense.
So that brings us right to the big question, the central puzzle, really. Can a single portfolio actually thrive, no matter what the market decides to throw at it? Is there one strategy that can truly conquer any environment? Let's see if we can solve this thing.
All right, so to test any strategy, we first got to understand the battlefield. See, the market isn't just one single thing. It's more like a series of really distinct environments. We're going to call them arenas, and every strategy we look at will have to prove itself in each and every one.
First up, we've got the rising bull. This is the easy money environment, you know? Think back to 2017, when the S&P 500 just kept climbing and climbing with almost no drama. It's the kind of market that makes pretty much any strategy look like it was designed by a genius.
Then you've got the sideways market. This is that super frustrating, going nowhere fast kind of market. It's just stuck in a range, not really going up, not really going down. And let me tell you, this can be a real headache for strategies that need a strong trend to make any money.
Next, the grind down. Now this isn't a sudden, scary crash. It's more like a slow, painful bleed. Picture a market that's just consistently losing a little bit of ground, day after day, but without those big, dramatic headlines. This is the kind of environment that just slowly wears down your confidence over weeks or even months.
And finally, the crash. This is that sudden, sharp panic that we all dread, right? We're talking about a fast, steep drop, where the market's fear gauge, the VIX, just goes completely off the charts. This is the arena that really, truly tests every investor's nerve. Okay, so let's meet our competitors. We've lined up 8 different funds and strategies. Each one has a totally different approach, and they're all ready to step into the arenas.
So here's the lineup. First, we've got the S&P 500. That's our main benchmark. Then our case study, the Modern Options Portfolio. We've also got a high-profile pro in the mix, Bill Ackman's Pershing Square. After that, we have the top-performing hedge fund from each of the 4 years we're looking at. Think of them as the yearly champions. And finally, we've got an index for the average hedge fund, just to see how the pros did as a whole.
All right, now for the main event. We are going to run all 8 of our contenders through the gauntlet, through each and every one of those 4 market arenas we just talked about. We're going to find out who wins, sure, but maybe more importantly, we're going to see who survives.
Let's kick things off with the first, and let's be honest, the easiest arena, the calm, optimistic world of the 2017 rising bull market.
Now, the first thing that probably jumps out at you here is that massive bar for the top hedge fund in 2017, a crazy 233% return. I mean, amazing, right? But I want you to look closely at those little red bars. Those represent the maximum drawdown, the biggest loss from a peak. So even the huge winners took some hits. Our focus, the Modern Options Portfolio, it came in 5th with a solid 10% gain.
And this right here, this illustrates a really crucial point. Even in its lowest ranked market, this portfolio had 0 down months. It didn't get the biggest win, no, but it took on literally 0 risks to get its return. Now that is a powerful trade-off to think about. Okay, let's move on to the next arena and see how things stack up during that frustrating directionless sideways market of early 2015.
And right away, you can see things starting to shift. While the S&P 500 actually lost a little bit of money and other funds were struggling to find their footing, our Modern Options portfolio climbed the ranks. It secured a strong second place with an 8% return and, get this, with a tiny drawdown of less than 0.5%.
Now, for the real test, that slow, painful decline of late 2018. This is the grind down arena, which the source material called the single most difficult market for our portfolio.
So here's the key thing. Even in what was supposed to be its absolute worst environment, the portfolio still came in first place. It managed a positive return of nearly 3%, while the S&P 500 lost over 14%, and pretty much everyone else was deep in the red. It protected capital better than anyone else, period.
And get this, that tiny dip you see, just 1.1%, that was the single biggest gut punch the portfolio took in any single month over the entire 4-year period. I mean, that is some serious defense.
And finally, we enter the arena of pure panic. We're actually looking at 2 separate crash events here, one in August 2015 and another in February 2018, to see how these contenders handle a sudden, violent drop.
Well, the results here are about as clear as it gets. In both crash scenarios, you just see a sea of red. Most funds and the S&P 500 lost money. But look at our contender. It delivered strong positive returns in both cases. It didn't just survive the panic, it actually profited from all that chaos. So, after running this gauntlet, a clear winner does emerge. But you know what? It's not the one with the flashiest, highest return in a single year. No, it's the one that showed quiet, consistent resilience across the board.
Here's the first big reason why. Out of all 8 contenders, it was the only one that was profitable in every single one of the 4 market types we tested. It made money when the market went up, when it went down, when it went sideways, and during a crash.
And second, and honestly this is the most important part, it took the #1 spot for protecting capital. It had the lowest drawdowns, the smallest losses in all 8 of the test periods. Its defense was, well, it was simply unmatched.
And this brings us right back to where we started, summed up perfectly by Warren Buffett himself. This whole study seems to prove his point, doesn't it? It suggests that maybe the flashiest offense doesn't win the championship. Maybe the real key to being an all-weather portfolio is having an unbreakable defense. Which leaves us with a final question. Is resilience, not just return, the true secret to winning the long game?
All right, let's get right into it. Today, we're not just talking about placing a few trades here and there. Nope, we're talking about building something strong, something that's designed to last. We are going to lay out the blueprint for a trading fortress, a system built to stand up to whatever the markets throw at it.
So let me just ask you this, right off the bat. Is your trading portfolio built to last? Or is it kind of like a house of cards? Just waiting for one bad day, one gust of wind to come and knock the whole thing over? Seriously, think about it. The answer to that question really comes down to whether you're just trading or if you're building a system. So here's our game plan, our blueprint for the day. First, we'll lay the foundation, why a system is everything. Then we're going to forge the walls by stress testing our strategies. After that, we'll dig a deep moat by planning for the absolute worst-case margin. Then we'll stock the treasury by figuring out how to calculate our real returns. And finally, we'll open up the toolkit and look at the methods you'll need to put it all together.
Okay, first things first, the foundation. Before you even think about putting on a trade, you have to get this part right. Because without a solid foundation, everything else we talk about today, well, it's basically useless. It's like building a skyscraper on sand.
You see, a real options portfolio isn't just a random collection of trades. It's more like a living, breathing ecosystem where every single piece affects every other piece. A new trade might look great on its own, but what if it secretly doubles the risk of your entire portfolio? That's the weak link that can bring the whole thing crashing down. You need a system to manage all those complex moving parts.
And what are those moving parts? Well, in the trading world, we call them the Greeks. They're just fancy names for risk. The first-order Greeks are the big ones. Delta is your risk from price changes, theta is the tick-tock of the clock, and vega is your risk from volatility. But it gets way deeper. You have second-order Greeks like gamma and Vomma that measure how your first risks change. Trying to juggle all of that in your head in real time, it's impossible. That's exactly what a system is for. All right, foundations poured. We know what forces we're up against. Now it's time to build and test the walls of our fortress. This is where we see if our brilliant ideas can actually take a punch before we risk any real money.
Now, here's a game-changing idea. Instead of spending weeks, maybe months, backtesting a strategy just to find a fatal flaw at the very end, the goal here is to find those weaknesses immediately. It's all about failing fast, so you can find what actually works, faster.
And here's how you do it. It's actually pretty simple. You take your trade idea and you drop it into the past. Then you run it through an absolute gauntlet. You throw every market at it. Bull markets, bear markets, sideways grinds, high volatility, low volatility. The entire process is designed to break your strategy, to find its weak spots right away so you can either fix it or, just scrap it and move on without wasting a ton of time.
So what are we looking for in the stress test? Well, it all boils down to one thing, positive expectancy. Don't let the fancy term scare you. It's a simple idea. It just means that over hundreds or thousands of trades, the math is on your side. Think about it. You want to be the casino, not the gambler. The casino might lose a single hand of blackjack, sure, but they know that over time, the odds are stacked in their favor. If your strategy doesn't have that edge, it's just a coin flip, and it has no place in our fortress.
Okay, the walls are tested. Now for what is arguably the single most important defense for your entire fortress,
It's time to dig the moat. This is what protects you from the one thing that blows up more traders than anything else, the margin call.
Just picture it. The market is going absolutely nuts. Your screen is just a sea of red. And then, the phone rings. It's your broker. They need more capital, a lot more, and they need it right now. This is the moment when the house of cards comes crashing down.
So let's see how it happens. You open a position, looks good. Your broker says, okay, you need to set aside $5,000 in margin. Seems totally manageable, right? No problem.
But then, it happens. The unexpected. Volatility just explodes. The market tanks. It's a crash. And all of a sudden, your positions are under unbelievable pressure.
And that $5,000 requirement? Gone. In the heat of the moment, your broker now says you need $20,000. That's a fourfold increase, seemingly out of nowhere. This is called margin expansion, and folks, it is a silent portfolio killer.
And this quote just nails the consequence. If you don't have that extra cash on hand, you are forced to sell your position at the worst possible time, locking in a massive loss and giving up any chance you had for that trade to recover. It's catastrophic. It's game over.
So here is the key takeaway, the absolute crucial point. Your moat is built by planning for the worst-case peak margin requirement, not the comfortable, easy number you see on day one. You have to stress test for it, and you have to reserve capital for that nightmare scenario. That is your defense. That is your moat.
Okay, so our fortress is defended. Now let's talk about stocking the treasury. How do we actually measure our success? Because if we get this part wrong, we could be fooling ourselves into thinking we're getting rich when we're actually on the brink of going broke. There are really two ways to look at this. There's return on margin, which only looks at the capital that's actively tied up in a trade. This one can make you feel really good, but it's misleading. Then there's return on planned capital. Now this is the one that tells the truth. It includes all the money you set aside, including that big pile of cash for your worst-case margin scenario.
And this example makes it crystal clear, doesn't it? Let's say you make a $10,000 profit. Fantastic! If you only called the $50,000 in active margin, you're high-fiving yourself for a 20% return. But if you were being responsible and had $100,000 in planned capital to survive a crisis, your real, your honest-to-goodness, risk-adjusted return is actually 10%. That's the number that matters.
All right, last piece of the blueprint, the toolkit. Every fortress builder needs the right tools and techniques to actually get the job done. You know, the system you build can take a lot of different forms. Maybe it's an always-on strategy, where you're constantly in the market. Or maybe it's a conditional one that waits patiently for the perfect moment to strike, like when volatility spikes. There are all kinds, but the core principles we've talked about, the foundation, the stress test, the moat, they apply to every single one of them.
And to test all this stuff, you're going to need some software. You could go the scripted route with Python or R. It's incredibly fast, which is awesome, but it can be a little rigid. On the other hand, there are manual input tools. They're slower, for sure, but they give you this incredible flexibility to try out new, creative ideas on the fly. So it's really a trade-off between speed and pure dynamism.
So there you have it. The blueprint is complete. A solid foundation, stress-tested walls, a deep moat to protect you from margin calls, and an honest way to count the gold in your treasury. The plan is right here, in your hands. So the only question left is, what are you going to build first?